I made money last year. I'm going to make more money this year.
Yes, 2023 is the year when the legendary Warren Buffett is getting ready to buy big on the upcoming market collapse. In this video, the 5th richest man in the world gives you 5 crucial rules that will allow you to make a fortune in the big looming crisis. You won't just stop fearing collapses, you'll look forward to them. Since 1965, Buffett's portfolio has brought him 3,787,464% profit, compared with a total market return of 24,780% over that period. He owes most of his success to his unique ability to invest during market collapses. Since 1965, the S&P 500 index has shown negative annual returns 12 times, and in 10 of those 12 periods, Buffett's company Berkshire Hathaway performed better than the S&P 500. And now it's the summer of 2023. The time of cheap money is over. The pandemic, wars, huge inflation, and aggressive Fed actions have brought the economy to a halt. We have already seen the beginning of the banking crisis. The real estate market is next in line. The recession is right around the corner. And as it comes, we may see major market collapses. These are the periods, in Buffett's opinion, the best time to grow rich. That's why the largest share in a Berkshire Hathaway portfolio takes cash, not stocks, nearly 1/3. Buffett is getting ready for the upcoming storm and is going to make the most of this opportunity. If you apply the following tips from the most successful investor in history and seize this opportunity properly, you'll be rewarded big time as well. The stock market is the only place where investors run away from the store during a sell-off. The very first piece of advice from Buffett is, when the market collapses, under no circumstances should you panic and sell off the stocks of good companies.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. If you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. Some people are not actually emotionally or psychologically fit to own stocks.
Most follow a completely wrong logic. Don't be like that. Get rid of the stock only if the drop in its price is caused by a force that will permanently reduce the ability of the business to generate revenue. But if it's a great company that just got caught up in a whirlpool of events, if its downfall is caused by man-made factors, sanctions, or geopolitical turmoil, don't succumb to the crowd's instinct. Fearful when others are greedy, and greedy when others are fearful, was his second piece of advice. Buffett urges us to be proactive.
Biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do. They were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion. For big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you really gotta grab them when they come.
Market collapses present excellent but very rare opportunities that should definitely be seized. Since 1926, bear markets have lasted a combined total of almost 15 years, while bull markets about 75. The last major decline was in 2008. One could argue that there was also a market collapse in 2020, but by that point, companies were in fact overpriced, and the S&P 500 index rebounded quickly after the decline and renewed its high within a year. But let's take the 2020 decline as an example. If you had invested $10,000 at the peak back then, it would have turned into around $13,000 today. But if you had invested those $10,000 at the very bottom, you would have roughly $20,300 today. You can't predict when the bottom is, but this example shows that if you're facing a stock market decline, you should try to take advantage of it. Just think how rare the events that are happening right now in the world economy are. Like this video and subscribe to the channel, and you will definitely be able to capitalize on future opportunities. never invest in a business you cannot understand. Here's what old Warren Buffett has to say as the third piece of advice.
I mean, understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. You know, if you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business.
This advice is essential because during a market collapse, many companies make headlines. In 2020, it was airlines and travel companies. But under no circumstances should you invest in a company if you can't predict its prospects.
And you know, that is the key. So if I understand a few things and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it and the stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should.
So be sure to define your areas of competence and act within those borders. It's better to buy a great company at a good price than a good company at a great price. This advice is to avoid ranking your buying list by price, but to always rank the companies you are watching by the business quality.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50, it made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar with one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, you know, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
It's during market collapses that there are a lot of companies whose stocks are sold cheaper than the others. But a stock is not a good investment just because it is cheap. The quality of the stock is more important. Wait for the prices of the fundamental companies to reach a fair level. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Buffett also frequently says that his favorite period to hold a stock is forever. These wise quotes bring us to the last, but perhaps the most important piece of advice. It is to always focus on the long term.
The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for a huge opportunity, just huge opportunity. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich.
Buffett has a point. In the stock market, it's not the brain that matters, it's the emotional control. You have to be the kind of person who doesn't care about next week or next month. Buying stocks of big companies in turbulent times and holding them for a long time is the best investment strategy. Write in the comments for what time period you usually buy stocks. By applying these rules during a future market collapse, you'll have a great chance of making huge profits. And the many specific investment ideas you'll hear from another investing guru, Ray Dalio, in this video.